All right, today we are digging into Banc of California's latest earnings call for the fourth quarter. And this one, well, it wasn't your typical report. It was a real head scratcher for investors, a perfect example of what happens when great news runs into a wall of skepticism. So let's get into it. The whole story of this quarter really just comes down to one big contradiction. The bank put up some fantastic numbers, right? They beat expectations, but the stock actually went down. And that is the big question we're going to unpack here. If the numbers looked so good on paper, what on earth spooked the market? To figure that out, we have to start with the data. I mean, on the surface, everything looked incredible. Earnings per share, or EPS, came in at 42 cents. That's a solid 5-cent beat over what the analysts were expecting. And then you look at revenue, over $292 million, which beat the street by more than $4.5 million. Seriously, these are the exact kinds of headline numbers that usually make investors pretty happy. But that is not what happened here. Not at all. On the day of the earnings call, the stock closed down almost 2%, and it was on huge volume, more than double what it normally trades. So this is the puzzle we need to solve. And the first piece is understanding the incredibly bullish story management was telling everyone. Okay, so the leadership team at Banc of California basically came out swinging. They were brimming with confidence. Their message was crystal clear. All that messy integration stuff from last year is over, and this year was all about hitting the gas. And you could really hear it in their tone. The CEO, Jared Wolfe, he went off script right at the start of the call and said it felt like they played a ton of offense. That's not just corporate speak. That's setting a really aggressive, really optimistic tone for the whole call. And look, this wasn't just talk. They absolutely backed it up with some seriously impressive numbers. Loan production for the whole year was up a massive 31%. In just the fourth quarter, loan growth was humming along at a 15% annualized rate. And here's the kicker. On the other side of the ledger, their cost of deposits actually went down. That is the magic combo right there, exactly what you want to see. Now, listen up, because this is the absolute core of their entire bullish argument. Management made it super clear that a ton of that loan growth happened really, really late in the quarter. So what does that mean? It means the bank didn't really get to collect much interest income on those new loans in Q4. Instead, it's like a built-in tailwind, a guaranteed boost of about $13 million in income that's going to show up in the next quarter's results. And it's that tailwind that gave them the confidence to come out with this really strong guidance for the year ahead. They're telling the world to expect 10 to 12% growth in net interest income and a huge 20 to 25% pop in their pre-tax, pre-provision income. So that's the bull case in a nutshell. Great quarter, awesome momentum, and a super confident outlook. Which, of course, brings us right back to our puzzle. If the story is so good, why did the stock drop? Well, from the market's point of view, it all boils down to just one word: expectations. See, you have to look at the context here. Over the last year, Banc of California stock was up nearly 32%. Meanwhile, a general basket of regional banks, the KRE ETF, was up less than 7%. So BANC had already been on an absolute tear. The good news, it seems, was already baked into the price, and expectations going into this report were through the roof. So this really lays out the two competing narratives perfectly. On one side, you have management selling this awesome story about future growth, that built-in tailwind. But on the other side, you've got the market, which has already paid up for that story, folding its arms and saying, all right, show me. The guidance was good, for sure, but after a 32% run-up, the market was basically asking, is that it? You've got to prove it to us now. It's a classic show-me story. So when you put all these pieces together, management's confidence and the market's skepticism, what does it mean for the stock going forward? Well, let's lay out our verdict for the next call. Here's how we see it playing out. First, in Q1, we fully expect that $13 million tailwind to show up in the numbers. But one good quarter isn't going to be enough to convince a skeptical market. So second, the stock is probably going to be stuck in a range for a bit. You have this tug of war between the bulls who love the growth story and the bears who point to the high valuation. It's a stalemate, really, until the company can prove they can execute at this high level for more than just a single quarter. And that all leads us to our final rating. The company is clearly firing on all cylinders, that's real, but the market's high expectations are also very real. So when you balance those two powerful forces, we're initiating our coverage with a market perform rating. Okay, and now for a little something extra. Let's talk about a potential trade idea that you could build based on this whole analysis. So, the idea here is a classic Wall Street strategy called a pairs trade. You'd go long Banc of California, meaning you're betting on it to go up, but at the same time, you'd short the regional bank ETF, KRE. Now, why would you do that? Well, this trade is designed to isolate banks' specific story. You're betting that their great execution will help them outperform their peers no matter what. And by shorting the whole sector, you're protecting yourself in case some big macroeconomic hits all the banks. It's purely a bet on banks' relative strength.
This is not financial advice.